Good morning and welcome to TOITOI Japan Market Radio. I'm coming to you from Tokyo on March 19, 2026. This is your daily briefing for global investors tracking Japan's equity, currency, and fixed income markets. Let's dive straight into today's session.
Thanks for having me. Today was a challenging session for Japanese equities. The Nikkei 225 closed at 53,372.531, down 3.38%, while the TOPIX fell 2.969% to 3791.0. We saw broad-based weakness with the Mothers Index dropping 3.502% to 2425.0, and even J-REITs declined 1.37% to 1980.0. On the currency side, USD JPY was essentially flat at 158.931, up just 0.026%. Commodities told an interesting story too, with gold in yen terms falling 3.316% to 18,225.0, while crude oil was virtually unchanged at 96.31, down only 0.01%.
That's quite a divergence between the equity weakness and the currency stability. Before we unpack the drivers, let's talk about what initially appeared to be conflicting headlines. Earlier reports suggested the Nikkei closed at a record high driven by automaker strength and yen weakness, but clearly the actual close tells a different story. What's your read on this?
You're right to highlight that discrepancy. What we're likely seeing is a situation where intraday momentum from the automaker sector and yen dynamics pushed the index higher at certain points, but geopolitical concerns and broader risk-off sentiment ultimately dominated by the close. The automotive sector did benefit from the weaker yen environment, which at these levels around 158.931 provides a substantial tailwind for exporters. A depreciated yen makes Japanese vehicles more competitive in overseas markets and boosts repatriated earnings when converted back to yen. That's textbook positive for companies like Toyota, Honda, and Nissan. However, that sector-specific strength wasn't enough to overcome the broader market headwinds we saw today.
So the yen weakness is still working in favor of exporters, even if it couldn't save the broader index today. Meanwhile, in corporate news, we saw Mitsubishi UFJ Financial Group emerge as the most actively traded stock on the JPX, closing up 1.00%. The move was attributed to rate cues. Can you walk us through what that signals?
Absolutely, and this is a critical data point for understanding where the market thinks Japanese monetary policy is headed. MUFG is Japan's largest bank by assets and essentially a bellwether for the entire financial sector. When you see bank stocks rally on rate cues, the market is pricing in expectations of a more hawkish Bank of Japan or at least continued policy normalization. Banks benefit enormously from rising rate environments because higher yields expand their net interest margins, the spread between what they pay depositors and what they earn on loans. After years of zero or negative interest rate policy, even modest tightening is meaningful for profitability. The fact that MUFG finished positive while the broader market sold off suggests investors are differentiating between sectors that benefit from normalization versus those hurt by it.
That's a sophisticated rotation. How should we think about the implications for the broader equity indices given that financials carry substantial weight in both the Nikkei and TOPIX?
Financials represent roughly 15 to 20% of both indices, so moves in this sector do matter. MUFG's strength likely provided some support to the overall index, preventing an even steeper decline. However, there's a trade-off here. Higher rate expectations that benefit banks can pressure valuation multiples for growth stocks and duration-sensitive sectors like technology. These companies tend to have cash flows weighted further in the future, which get discounted more heavily when rates rise. So while financials outperform in a rising rate environment, you often see underperformance in growth and long-duration equities, which can weigh on the indices overall. It's a classic rotation dynamic.
On the policy side, if markets are indeed pricing in higher rates, what does that mean for the yen and JGB yields?
Great question. Typically, when rate expectations shift higher, you'd expect yen appreciation as carried trade dynamics adjust and Japan's yield advantage relative to other markets narrows. However, today we saw USD JPY essentially unchanged at 158.931, up only 0.026%. That suggests the market is still digesting mixed signals. The yen remains weak by historical standards, and we haven't seen meaningful intervention or a sustained reversal yet. For JGB yields, if the market is pricing in BOJ tightening, we should see the 10-year yield move higher, which reduces bond valuations but further supports bank profitability. It's a delicate balance for the BOJ because they want to normalize policy without destabilizing the equity market or triggering excessive yen strength that would hurt exporters.
Staying with the macro theme, we need to address the geopolitical factor that appears to have weighed heavily on sentiment today. The Nikkei's 3-day decline has been linked to escalating concerns around an Iran crisis, with markets worried about stagflation risks. Why is Japan particularly vulnerable to this scenario?
Japan's vulnerability to Middle East geopolitical tensions stems from its heavy reliance on energy imports. Japan has virtually no domestic oil production and imports the vast majority of its energy needs. When tensions escalate in the Middle East, oil prices typically spike, which directly increases input costs across the entire Japanese economy, from manufacturing to transportation to utilities. The stagflation concern is especially acute because higher energy costs create a toxic combination. They fuel inflation while simultaneously constraining consumer spending power and corporate profit margins. This is exactly the scenario that complicates the Bank of Japan's policy calculus. If inflation rises due to external supply shocks rather than healthy domestic demand, the BOJ faces a dilemma: tighten policy to combat inflation and risk choking off the fragile growth recovery, or maintain accommodation and risk entrenching inflation expectations.
That puts the BOJ in a very difficult position. How is this dynamic playing out across asset classes today specifically?
The market reaction today reflects classic risk-off behavior with a stagflation overlay. For equities, the Nikkei 225 and TOPIX both sold off sharply as we discussed, down 3.38% and 2.969% respectively. Investors are repricing growth expectations lower and demanding higher risk premiums. Multinational exporters, despite benefiting from the weak yen, face margin pressure from elevated energy costs. On the currency side, in pure geopolitical crises you typically see flight to safety flows that benefit the yen as a traditional haven currency. However, today's minimal movement in USD JPY suggests those flows are being offset by other factors, possibly concerns about Japan's own vulnerability to the energy shock. For JGBs, risk-off sentiment usually pushes investors into safe haven bonds, putting downward pressure on yields. At the same time, if markets revise growth expectations lower due to stagflation fears, that could also reduce expectations for future BOJ rate hikes, which would also support bond prices and lower yields.
So we're seeing multiple crosscurrents in the market today. The banking sector is responding positively to rate normalization signals, automakers are benefiting from yen weakness at least on a fundamental basis, but the broader market is selling off on stagflation concerns tied to Middle East tensions. How should global investors be thinking about positioning in this environment?
It requires a nuanced sector-level approach rather than a broad Japan view. Financials look attractive if you believe the BOJ will continue gradual normalization regardless of near-term volatility. MUFG's performance today demonstrates the market is willing to reward that trade even in a weak tape. For exporters, particularly autos, the weak yen remains supportive, but you need to monitor whether energy cost pressures offset the currency benefit. The risk-off move in growth stocks and defensives suggests investors are rotating toward quality and value, which makes sense in a stagflation scenario. From a portfolio construction standpoint, having exposure to sectors that benefit from different macro outcomes provides natural hedging. Banks benefit from rates, exporters from currency, but both face headwinds if growth deteriorates meaningfully.
Shifting back to equities, the decline in the Mothers Index was particularly severe today, down 3.502% to 2425.0. That's notably worse than the main indices. What does that tell us about risk appetite?
The Mothers Index represents smaller, growth-oriented companies, and they're typically more sensitive to risk sentiment shifts. When markets turn risk off, investors tend to sell their most speculative positions first, and small-cap growth stocks fit that description. The 3.502% decline versus 3.38% for the Nikkei 225 confirms that today was a broad risk reduction day rather than sector-specific weakness. It also reinforces the point about duration sensitivity we discussed earlier. Smaller growth companies often have longer paths to profitability, so their valuations get hit harder when discount rates rise or growth expectations fall. The sell-off in Mothers stocks is consistent with both rising rate expectations and stagflation concerns.
We should also mention the decline in J-REITs, down 1.37% to 1980.0. Real estate investment trusts are another interest rate sensitive sector. Is this purely a rate story, or are there other factors at play?